Good afternoon. I'm Jeff Brickman, Senior Investor Liaison at the FASB. I'd like to welcome you to the first in a series of investor-oriented webcasts that will focus on the impact from the new revenue standard. Today we will discuss the aerospace and defense sector and are pleased to have executives from both GE and Raytheon with us. Joining me are GE's Global Technical Controller Russell Hodge, Raytheon's Chief Accounting Officer Michael Wood, FASB Board Member Mark Siegel, and Cullen Walsh, who is an FASB Assistant Director. We will be holding a question and answer session after a brief overview on the standard. During the overview, we'll have a few slides that will be displayed that you should be able to follow along with. While we would try to hit on as many of what we view are the key impacts from the standard, we welcome additional questions from you. You can send them in to us at adrevrec@fasb.org. The email is listed at the bottom of the slide that is currently on the screen. We will try to answer questions that we receive throughout the webcast, so please send them in, and we won't be sharing the names of who is asking the questions, so don't worry about being singled out. Finally, a reminder that CPE credit will not be offered for today's webcast, and that the views expressed today are those of the presenters. Official positions of the FASB are reached only after extensive due process and deliberations. Cullen, I'll turn it over to you to provide an overview of the revenue project, and then we'll begin the Q&A session with our panelists.
Sure, thanks, Jeff. Yeah, I'll provide just a very brief overview of the standard to try to set a baseline for all the investors on the call before we jump into exactly what does the new standard mean for those in the aerospace and defense industry. So first question is, why did the FASB and why did the Iasb decide to change revenue recognition guidance? Well, for those that are U.S. GAAP preparers, GAAP is very complicated on the revenue front. We have well over 100 pieces of guidance that have been developed over decades, and there's not a cohesive principle that holds all that guidance together, which means that economically similar transactions sometimes are accounted for differently based on very minor nuances in a contract or based on the industry that the company happens to be in. Also, one real deficiency in our revenue guidance today is very limited disclosure about revenue transactions. You know, it's interesting to me when you think about other areas in the financial statements like income taxes or stock comp or pensions. It's not unusual for companies to have pages of disclosures about those items, which really are just elements of individual expenses, and yet revenue, which is arguably one of, if not the most important line, there's actually very few revenue disclosures. Some companies are very good at providing more than what's required, but in terms of what's required, it's really minimal. From an IFRS perspective, they have very little revenue guidance, and so they have diversity in practice both among IFRS preparers and also compared to U.S. GAAP preparers. So the FASB and the Iasb decided to work together to develop a joint standard, a converged standard on revenue recognition so that all companies around the globe are following the same set of rules when it comes to revenue recognition. And we think that this new guidance, this new revenue guidance, addresses many of the deficiencies that exist today in revenue accounting. And in particular, it puts in place one overarching framework that all companies can apply when accounting for their revenue arrangements. So whether you happen to be looking at a company in the A&D space or the software space or the retail space, they're following the same set of guidance. The other key thing that we think the new standard does is it should add more transparency to how companies recognize revenue and when they recognize revenue based on a package of disclosures that we have in the new guidance. So the new standard is organized around 5 key steps, which is right on the screen in front of you. And I think the steps are fairly intuitive. I'll briefly mention them, and then much of the discussion that we'll have with Russell and Mike is to go a step deeper and talk about, well, what do these 5 steps mean for companies in the A&D space? So first, you're identifying what is the contract with the customer. What are the enforceable rights and obligations between the two parties? And then you're trying to identify what are the promises that I've made in a contract to my customer. And then you're trying to figure out what is the total amount of consideration that the customer is going to pay me for all those promises. And in the new revenue standard, that includes sometimes estimating variable consideration, which can include things like a performance bonus, but it would also include something as simple as a right of return or a rebate provision. So it's an estimate of, at the end of the day, what do I think I will get paid for these promises? The next step is to allocate that total pot of consideration that you estimated to each of the performance obligations. And then finally, the best step is when you actually recognize revenue for each of those promises made in the contract. And depending on the nature of the promise, in some cases, revenue will be recognized at a point in time. So think about when the product is shipped or when it arrives at the customer's location. And in other circumstances, revenue will be recognized over time. And if revenue is recognized over time, a key judgment that a company needs to make is, well, what will my pattern of revenue recognition be when recognizing revenue over time? That's particularly applicable to A&D, and that's something we'll talk about with Russell and Mike as we progress. So what is the impact of these 5 steps compared with existing revenue guidance? Well, the answer is it depends, and it will depend not only which industry you're talking about, but it also can depend company to company. And the reason for that is there are many different ways that companies recognize revenue today, even within the same industry. And so, there's probably some broad strokes you can brush in terms of which industries would be impacted the most and how. But one thing I think you'll learn from our discussion today with Russell and Mike is that in order to make an assessment of the impact, you do have to think about what is a company doing today in order to be able to figure out the extent of the impact. I think Mike and Russell have some good examples that will demonstrate, even within this industry, why for some companies the impact may not be all that significant, and then for other companies the impact will be much more noticeable in terms of the amount of revenue recognized each quarter. One point we wanted to make that we think is important is even though the new standard puts in place an overarching framework that companies can apply to all revenue transactions, and even though it fills an absence of guidance that we have in certain areas today, judgment is a critical part of recognizing revenue. Today, companies often need to make judgments and make sometimes very difficult estimates in recognizing revenue, and that will be no different than under the new revenue standard. Some of the estimates might be a little different. In some cases, there might be more estimates. In other cases, there might be less. Really, the bottom line is that companies can have complex transactions with their customers, and certainly A&D is no exception to that rule. And so a company will need to make judgments and estimates to be able to follow this new standard and to recognize revenue. But a key thing that we've done that is different from today is the disclosure requirements. And a summary of some of the key disclosure requirements are in front of you, but they were designed with help from investors to provide investors with more granular information about revenue. What are the key estimates and judgments that are made? How do those change over time? Exactly what triggers revenue recognition for a company? And of the contracts that a company has in place at the end of a quarter, how much more revenue will be recognized in the future associated with those existing contracts? So when and how will a company transition? So for a public company, they're required to adopt the new standard in fiscal year 2018, at the beginning of 2018, but public companies are permitted to adopt the standard in 2017. From what we understand, there are not that many companies that are early adopting in 2017, but there are some, including a few companies in the A&D space. And as a matter of fact, Raytheon happens to be one of those companies. In terms of how companies will adopt the standard, all companies will have to provide some degree of comparative information. There's a few different options that companies can avail themselves as to exactly how they adopt. But one important thing to keep in mind is regardless of the approach that they take, you will be able to have some degree of trend information to understand revenue trend lines without the impact of having this significant transition to the new revenue standard. The last thing I'll mention is that at the FASB, we are very focused on having a quality implementation of our standards, and we know that the change in revenue recognition is a major one, and so there's a lot of things that we're doing to try to help support implementation. The one that I think might be the most important to this audience is that at the FASB, the staff is very happy to take calls and to answer questions about the new revenue standard. So as you're getting your heads around what the new standard means, you absolutely can feel free to reach out to Jeff or to anyone on the staff, and we will do our best to help you, give you a sense of how the new standard might impact a sector that you look after. So with that, Mark, I'll turn it to you and start our discussion.
Thanks, Colin. I appreciate it. And I just wanted to extend my gratitude to Mike from Raytheon and Russell from GE. We're really grateful to have you guys on the line today to help us educate investors about the impacts in the A&D industry of the new revenue recognition standard. So let me start off with a question for Mike at Raytheon. You guys at Raytheon adopted the standard early, as Cullen mentioned, and so you've now reported under the new revenue standard for the first quarter of 2017. So how has the transition gone from your perspective, and have you had many questions from investors or analysts on the new rules or the new reporting?
So, Mark, I recently heard somebody who was a hiker describe they had hiked the Appalachian Trail. When they got to the end, there was the sign in Maine that said the trail was ending, so they knew they had done the whole journey. And they broke down and started crying and couldn't let go of the sign. And that's kind of the way I feel about the first quarter filing. Is we're after a very long journey, starting with the final standard being issued in 2014, but even before that, going all the way back to 2008, analyzing various exposure drafts, there's been a tremendous amount of work that's been done, really, understanding how to apply the standard, identifying the differences in our contracts and having to do that, literally at a contract-by-contract basis, then taking into account what you got to change from a process point of view, and putting in place systems and processes to collect the data and the disclosures, and then implementing controls around those to make sure that you have adequately controlled your new revenue standard transition, making sure that it's sustainable and can go forward, and all along the way communicating both with senior management, the board, and really, if you think about it, all the way down to the program level where you have program managers and program finance people, running programs so they understand the differences. Now, we had very little impact, even though we had all that effort and had to go through the process. Our change in 2016 revenue was around $55 million. So that's on, over $24 billion in sales, but it was quite a journey to get there. Because the change was small, we really didn't get a lot of, interest from investors on the change because they sort of think about us the same. But, nonetheless, the amount of effort that is needed to do that is a lot.
Thanks, Mike. I appreciate that. There was a lot of effort involved to get onto the new standard. And we'll talk about some other things investors might be interested in later when we get to disclosures. But turning to Russell, has GE announced when and how it plans to adopt the new revenue standard?
Yes, Mark. We, unlike Raytheon, we elected not to adopt the standard early. We're going to go and adopt the standard when it's effective, as Cullen mentioned, in 2018. So our first quarter of 2018 will be the first quarter that we apply it. We spent a lot of time thinking about how we would apply it, what method we would use, the full retrospective method or the modified retrospective method, and ultimately concluded that we would use the full retrospective method because it does, as we've already disclosed, it is expected to have somewhat of an impact on our financial statements, and so we wanted to make sure that we provided as much comparable comparative information that we could, and we thought the full retrospective method would be the most useful to investors.
Thanks, Russell. As you're looking to implement, what are the challenges or the opportunities in adopting the new standard for GE?
Yeah, so as it relates to the challenges, there, as Mike mentioned, there's a lot. I mean, this has been we've been following the standard and the developments of the standard setters and the FASB for probably 10 years as this project has evolved. So it's hard to really say how long we've actually been in the implementation phase of the project. But I would guess that it's probably been 18 months or so that we've been really driving towards the effective date and implementation. I would say that one of our biggest challenges is just the sheer size of and complexity of a company like GE. How do you make sure that you're driving consistent application and system changes across all the businesses? So I think that's probably one of the things that just and on top of that, we're fairly decentralized as well. So that makes it a challenge versus other companies. The other thing I would say, and this is sort of more of a broad comment, that it's probably the most cross-functional standard that's ever been implemented. I can't think of another standard that affects so many different aspects of a company, from IR to the sales and commercial teams to IT, tax. We're even finding obviously the obvious ones, financial reporting and controllership. But we're even finding that we're spending a lot of time talking about supply chain. You wouldn't think that, since it's a revenue standard, you wouldn't think that supply chain would come into the discussion. But now questions are coming up. Well, okay, if control is the thing that you're trying to understand and look at for revenue recognition, should you also be thinking about control from the standpoint of when you control things that you take and purchase through your supply chain? And there is an interrelationship, particularly if you're using cost to cost as your measure of progress, which we'll get into later. So the cross-functional nature of this standard is pretty it's unprecedented, I think. So everyone at GE is almost involved in this discussion. Maybe the last challenge I would say is just that the implementation issues can continue to be discussed, and so it's hard to really feel comfortable moving forward, even though we're having to do it anyway. And look, Mike has already adopted, right? Even though a lot of implementation questions are still being asked and still being discussed by various working groups with the AICPA. I know the firms are still having a lot of discussions amongst themselves. They're publishing books as we speak. I think last week KPMG put out a 1,000-page revenue recognition guide, which the timing is interesting, right? Because we thought we were pretty much done with most of our technical decisions, but now we have to make sure that there's nothing in that book that would be inconsistent with what we've already decided. So there's a number of challenges. The opportunities, on the other hand, are there as well. I think one of the things we've really been focused on is trying to drive consistency amongst our peers. We've spent a lot of time talking to our peers, and in this particular industry, the aerospace and defense industry, has been very collaborative, I would say, and it's probably because we're also collaborative in our business, so it made it easy to be collaborative with the accounting. But we've been very lucky from that standpoint, and I think that's why probably Mike feels good about a lot of the technical decisions that have already been made. It's because we've spent so much time as a group talking about them.
Thanks, Russell. Appreciate it. Mike, back to you. You said that the accounting outcomes weren't all that different under the new rules. I think you said about $55 million. What type of accounting methodologies or business do you have today that resulted in similar accounting under the new standard? What kind of methodologies exist that potentially for others could end up being a larger impact?
That's a great question, Mark. First I'll sort of talk about the old standard. You had to go through an analysis of what GAAP applies. And for us, contract accounting under the old SOP 81.1, the vast majority of our contracts fell under that, guidance. And under that, you had to determine a method to determine your percentage completion. So you would measure what percent complete your contract was and recognize that amount of revenue. And there were, different ways that the standard allowed you to do that. You could use your costs incurred to date compared to your total estimated costs, which commonly referred to as the cost-to-cost method. You could use milestones where you had distinct, achievements along the way and recognize revenue at that point, consistent with the milestone. You could use units of delivery where when you deliver a unit and the customer accepts it, that you'd recognize revenue for that unit. Raytheon's always had the view that the cost-to-cost measure was the best estimate of percentage completion accounting. And that was really because the vast majority of our contracts have something that's called termination for convenience clauses, where the customer can come to us and basically terminate the contract for their convenience, pay us the costs incurred to date, and a reasonable profit. And so when we looked at the new standard under Topic 606, you didn't have to figure out what GAAP applies. That was nice because there was only one standard for revenue recognition. And you had the model that Cullen talked about, which you were either going to be over time or you were going to be a point in time. And when we looked at the nature of our contracts, the termination for convenience, the control that the customer exercises throughout the construction of the assets, the overtime model made the most sense to us. And you're supposed to measure how you transfer control to the customer, and very similar to cost to cost, because you're transferring all the costs that you've incurred under the termination for convenience clauses over time, the answer becomes very similar. Now, there's minor differences in about 15, 16 other things that drove the $55 million difference, but the core nature of how we recognize revenue hasn't changed. Now, on your question of how could, what are some potential differences that could have a larger impact to others, and I think if you look at what others in the industry have disclosed, if you're using a milestone method today or a units of delivery method today or something other than cost to cost, many of folks are looking at cost to cost being the appropriate measure. So you're going to end up pulling revenue back under when you switch from a units of delivery to a cost to cost measure. What's one of the things that's challenging is everybody during this journey had asked me, well, is this going to change revenue, increase it or decrease it? And the answer is yes, depending on the period. You think about it, if you're switching from units of delivery to cost, you're going to push revenue behind you for costs that have been incurred in prior periods, but you're also going to pull forward revenue that you've been putting in inventory. That's your cost there. So I think that's the biggest changes. And to Cullen's point, I think it now makes the A&D industry much more comparable because everybody will basically be on a cost-to-cost method for the majority of their defense contracts.
Thanks, Mike. I think there's some great tidbits in there for investors to think about as they're looking through some of the disclosures of the companies they're currently covering. Russell, do you have anything that you wanted to add, any additional color from your perspective?
Yeah, so Mike's right. I mean, I think the A&D space has probably been accustomed to applying this overtime accounting model for a number of years, and some, including us, have used variations of cost to cost that may be more tied to milestones or output deliverables. And as we went through the analysis, at least as it relates to this particular area, it's probably we are going to have some changes. Those changes, as it relates to the overtime accounting model for equipment outside of commercial engines, is not expected to be that significant. But even though it doesn't have a significant financial impact, there's still a lot of system and process changes that you have to go through to be able to apply a true cost-to-cost accounting model. If you were, for example, today, if you were looking to measuring progress with a milestone, you could wait until the equipment was basically completed and shipped before you recognize revenue. Under the new standard, you've got to be able to make sure you're tracking all of your costs for accounting purposes, and so you've got to make sure your systems are capable of doing that. So there's I'd say, just getting, even though it might not seem like a big financial impact, it's still a significant change.
Thanks, Russell. Sticking with you for a second, I know GE and there's probably others in the A&D space that sometimes sell complex equipment and also expect to sell many years of service for those same assets, that same equipment. How do you think the new revenue standard might deal with those kinds of arrangements?
So we've spent a lot of time on this particular question. It's basically, as you alluded to, we kind of refer to it as the razor blade model, where you sell a piece of equipment, maybe at a loss or a relatively thin margin, with the expectation that you're going to have a long revenue stream over the course of the life of the engine or the equipment for spare parts and servicing that's required to take place. So you kind of have a built-in annuity, if you will. There was a lot of discussion and debate about, even during the deliberations of the new standard, whether those two types of arrangements or contracts could be combined for the purposes of recognizing revenue and cost. I suppose it was really focused on, should you be able to essentially levelize the margin across those two contracts. This is one that we actually spent some time, because there were some early indications that our peers were not going to be aligned in this area. And again, as I mentioned earlier, we really wanted to try and use this opportunity to drive consistency among the peers. So this ended up being a discussion that we had collectively with others in the industry, with the SEC, and the ultimate conclusion was, no, those are not only separate contracts, they're actually with separate customers, and they should be separated and accounted for as their own unit of account, which would essentially mean your margins are going to be reflected of the economics for each individual contract.
So they'd be sort of separate units of account, and the aircraft, the engine or the equipment sale would be one, and then the service would be another stream.
That's correct. Yeah.
Okay, that's helpful. So, Mike, let me get back to you at Raytheon. If you were to put yourself in the shoes of an investor or an analyst, what types of questions would you be asking the companies that you follow in the A&D industry?
So that's a great question, Mark. One of the things that I think is important is to understand that this is not a cash impact. Doesn't fundamentally, unless you've changed something, change how you run your business. And so I think it's important for investors or analysts to understand that context and, understand how they would reset their valuation models on companies and understand the changes that are driven and kind of the insight that you're going to gain a little bit about what things are moving around. So, if a company's going from units of delivery or milestone to cost, what does that really mean? And I think most of the large companies that haven't early adopted are planning to give insight into 16 somewhere in the middle half of this year. And so I think that's probably trying to understand that and understanding as well what transition methods they would use, because anything short of a sort of a full retro method, you're going to have to figure out how to reset your models to sort of put in perspective what their performance means. At the same time, really keeping in mind that this is just a rephasing of revenue. In general, you won't see revenue created or revenue eliminated. You just may see it in different periods. So I think those are the important ones, as well as I know we're going to get to it on the disclosures, understanding what new disclosures mean and the context of them, and how to really sort of think about how they inform you as an analyst as to the company's performance.
Good stuff, Mike. Thanks. I think Colin's going to jump in with a question from a participant.
That's right. We do have a question from an investor about the cost-to-cost approach. Mike, maybe I'll start with you, since you were the first one to have mentioned that. And the question we have is along the lines of, do you expect that revenue would be more or less lumpy when a company is using the cost-to-cost approach under the new standard? So if you take a fact pattern like yours, where you were already using cost-to-cost, you already had to make that estimate, do you think applying the new revenue standard lens to your contract will mean that the cost-to-cost is more or less lumpy than however it might be today?
So that's a great question. And it's going to really depend upon how you incur your costs, not to really be funny, compared to how you did it before. So, you think about it, when you think about what makes up cost, one of those components are labor, right? One of those components are materials and subcontracts, and then one of those components is sort of everything else. And, labor is a very usually stable component, unless you're going through a downturn or an upturn. And materials are going to usually come in over time unless you have a large buy. If you go back to sort of think about units of delivery, they're really driven upon, acceptance by the customer of a delivered unit. And so I think, the bottom line answer is it's going to really depend upon the mix of things that are going on. But at Raytheon, we haven't seen, over the years, because we've used the cost-to-cost method for many, many years, and certainly the last 10 years, we haven't seen a huge fluctuation of sales where one quarter you're, $2 billion, next quarter you're $5 billion. I don't know if that helped.
No, I think that does help. And is it fair to say that, look, estimating costs can be difficult, and sometimes companies have changes in estimates which drive changes in their revenue recognized for a contract. And at least in my view, interested in you and Mike, and Russell, but that could happen under the new standard as well, right? I mean, there's no panacea of estimating costs. It's hard to do for long-term contracts, and today there are periods in which a company has a change in estimate, and I think that would happen under the new standard as well.
Yeah, absolutely. If you're thinking about incurred costs, those are relatively easy because you've incurred them. You got invoices, payroll, et cetera. When you're thinking about estimating total costs, those are the most difficult judgments to make, because you're talking about what it's going to take to do in the future. That's really no different under the new standard than it was under the old. And many in our industry disclose the estimate at completion adjustments, where you may have positive or negative effects. And those positive and negative effects are also disclosed as now under the new standard of how they impact revenue. So, you can see all that in, all the major filings of what are the drivers. And I don't think the standard will have any impact on the volatility of that.
Maybe I would just add one thing. It maybe getting back to the basic question of whether a pure cost to cost model would be more lumpy than a units of delivery or milestone approach. I think in theory you would think it obviously would be, but a lot of it, as Mike pointed out, a lot of it depends on the nature of your business. For example, if you have a fully utilized manufacturing facility and you're producing the same number of units roughly every quarter, you're probably not going to have much of a difference between pure cost to cost and units of delivery or units of production. On the other hand, if there is a difference and your units of production tend to go up and down, the overtime cost to cost model you would think would be a little bit more levelized and smoother over time.
Good stuff. Thank you both. Russell, sticking with you for a second, one more question before we move on to disclosures. How at GE are you thinking about possibly educating investors about the new standard as you progress through 2017 before you adopt?
It's a good question. We have started thinking about the different ways we might go about that, but the good news about not adopting early is you get to see people, other companies go through this, and you can kind of follow their lead and really tailor it to make sure that you're providing the best platform for investors to really understand the nature of the changes. So we're going to keep a close eye on what others are doing and what investors really say they really like. So we'll probably just tailor it to that over time.
Thanks. And I know you've also got a pretty good lengthy discussion in your disclosure in your 10K for last year about how you're thinking about the new standard. So I encourage anybody that hasn't looked at it yet to take a read through that. It'll give you a good sense of what they're thinking and what questions you might want to ask others as you're looking at other companies too. Let's talk about disclosures. And Mike, since you were the guinea pig and you've already adopted the new disclosures and issued them for the first quarter, has there been an impact? What has been the impact of the new disclosures that you've seen in the first quarter?
Other than the preparation of them, I really haven't seen yet any significant feedback from our investors. Certainly the expansion of the disclosures, particularly related to disaggregation of revenue. To Colin's earlier point where there was very little disclosures in the past, we've always historically given a lot of disclosure about geography, type of contract, and major customer sales. But we went through and really broke that out a lot larger than we had done in the past, and giving folks the ability to see, by segment as required, the sales by customer, by contract type, by region. But I think generally the important part was getting our systems set up to be able to do that. One of the keys is, every contract has to be set up with its proper characteristics so that your systems can, be able to produce that. About 93% of our revenue is on one single instance of general ledger. So that provides us a lot of ability to get the data quickly. And I would say, we approached the disclosures relatively late in the process, and I would just encourage folks to probably address that earlier in the process, because there's a lot to absorb and think through in preparing the disclosures, and there are interpretations that you have to go through and figure out, okay, how to apply it. So, I would not underestimate the amount of effort with it, and I'm sure in the coming year or so we'll have investor feedback of how that has, improved them being able to look at the company.
Thanks, Mike. I know there was a lot of work involved to get ready for the disclosures, and I've heard other companies and audit firms have the same recommendation as you to start thinking about that process if you haven't thought about it already. There's a bunch of new disclosures, and Cullen mentioned them, that are going to be coming forward in the 10-Qs. So for investors, I think it's going to be important to make sure you analyze the 10-Q disclosures when they come out, and there should be some additional information in there. So Russell, moving on to you, let me ask you: are there particular new disclosures that you think are going to be key for investors or analysts to help them understand the A&D industry?
We're having a lot of discussions about, as Mike mentioned, there's a lot of interpretations as it relates to the disclosures. They on the surface, it would appear that you should feel like you would know exactly what should be included in each one. But then once you start to really look into them and look at the different interpretations that have come out, and particularly as it relates to how it interacts with other elements of the new accounting standard, like how you determine your transaction price, for example, there's a lot of questions that come up. So, understanding the what's underneath the disclosures, I think, is going to be important. I'll give you an example. So when we start talking about remaining performance obligations, it's also been referred to as a backlog disclosure. We already have a backlog disclosure that we include in MD&A, and so we've spent a lot of time trying to understand the difference between our backlog disclosure and what's really required in the remaining performance obligation disclosure, because on the surface you would think that those two things would be consistent, but as we are starting to understand, there's differences. And Mark, I know you've mentioned this before, but I would think of the remaining performance obligation disclosure as more of a subset of the backlog disclosure, because you're going to have some arrangements. The best example I could use is if you had a 10-year service contract that was more of a time and material contract. You're recognizing revenue mostly on a PO basis or a purchase order basis, and so that is not going to be included in the remaining performance obligation disclosure. Whereas the expected revenues over the life of that agreement, to the extent you've got some history with those types of arrangements, would be included in the backlog disclosure. If you had a similar contract that was more of an outsourcing arrangement with maybe fixed consideration, it might be included in the backlog disclosure as well as the remaining performance obligation disclosure. So there's just a lot that goes into that, and so making sure that our disclosures explain that in a way that's understandable is probably the key.
I'm glad you brought up that example, Russell, because that's a question that came in from a participant too. As the FASB and the Iasb were thinking about this disclosure, we knew that it was going to be a subset, and it wasn't going to tie out to the backlog that's disclosed outside the financial statements. But the way at least I, as a board member, got comfortable with the requirement was that I thought it would be good, insightful information for an investor to use, at least directionally, to understand whether or not the company's got some additional growth that's included in their contracts that will have some revenue associated with it. It's not to tie out exactly to the backlog that's disclosed outside. Again, that backlog that's disclosed outside is not necessarily, it's not a GAAP number, and it's not necessarily consistent from one company to the other. And so at least I thought it was an important number to disclose to analysts to help them get directional thought processes and ask questions. But I hear you, and I agree with you that depending on contract mix, how close it goes to the actual backlog disclosure that you have outside the financials is gonna vary. And with that, let me bring in Mike. Mike, you've now disclosed this this number. At Raytheon, are you seeing a significant difference or not between the remaining performance and the backlog you disclose outside?
We are not. In fact, we have the same number, and we have not elected any of the practical expedients because it was harder to elect those than to just apply them across the board. And the nature of our contracts are a bit different than what Russell had described. So I think we've seen somebody else who early adopt a very similar situation to ours. So I think like anything else with the new standard, as it brings consistency, it also brings, the need for a sharp eye over all of your contracts and their terms to really work them through the standard to understand how you fall. And, my understanding, having worked with the industry over the last few years, is there are sometimes very similar contracts to deliver similar items, but the economics are very set up differently. So I do think it's very important to understand that and to really go through directly your individual contracts and understand how that affects them under the standard.
Thanks, Mike. Sticking with you for a second, besides the remaining performance obligation disclosure that Russell brought up, are there any other particular disclosures that investors should try to get ready for or get a handle on? How do you think they should think about the contract liability disclosure and how it might compare to any unbilled receivables or deferred revenue that might exist today?
So in the past, we used to disclose contracts in process, which would cover all billed receivables, unbilled receivables, and then we would disclose advances. And we decided to adopt the new language in the standard to go to receivables, to go to contract assets, and to go to contract liabilities. And one of the things that the new standard does is give you an idea of liquidity, because receivables are, but for the passage of time, something you're going to collect. So think about those as billed amounts. And then contract assets and contract liabilities netted on a contract-by-contract basis as to whether you're in an advance position or liability position, or whether you're in an asset position, or whether you've incurred work but not billed it. So think about contract assets as your unbilled account and contract liabilities as your advances, and those netting together. So that's one. I think there's a new disclosure about revenue from contracts in an advanced position, and so that's a little bit tricky one to calculate, and you got to think that through. But thinking through what does that mean, and is there anything to be derived from that? And then as well, revenue on prior performance obligations is slightly different than EAC adjustments, the estimate at completion adjustments, because, if you have a loss adjustment, that would be not affecting revenue. So these are all those changes in estimates that would drive revenue in the current period. So I think getting arms around those and understanding what they mean is probably important.
Thanks, Mike. I thought you explained that really well, particularly around the the contract asset being the unbilled portion, contract asset, contract liability, and the more of an unbilled or advanced portion, and the billed receivables being obviously the amounts invoiced. Do you have anything to add to that, Russell?
Yeah, I would add just one thing, that it's not, the contract asset may not just be unbilled from the standpoint of it hasn't been, you haven't sent out an invoice yet. There could still be amounts in that contract asset or liability that's contingent on future performance. So it's not, because there's been some discussion and debate about whether the contract asset is a financial asset or a monetary asset, and I know there's probably different views on that topic, but it matters to some for different reasons. But from my perspective, it's not a monetary asset, because it's not just an unbilled number that is surely the passage of time that it gets collected. There could be amounts in that balance that's based on future performance as well.
Okay, that's a good point. Russell, as you look to the disclosure package, are there particular challenges or opportunities that you see as you're getting ready for it for 2018?
It's a challenge just from the standpoint of making sure your systems are capturing the data, and and we want to make sure we're starting the process now to do dry runs to make sure we are able to capture the data and have the right process around it and the right controls around it. That's the biggest challenge. I don't otherwise, making sure we articulate it and explain it in a way that users can understand. But otherwise, I think it's going to be helpful.
Thanks, Russell. As I look at Cullen, it appears that most of the questions that have come in we've already captured many of the answers in the overall Q&A. So please, if you have any additional questions, please email them into adrevrec@fasb.org. One question for you, Mike. What's the internal process at Raytheon for approving new disclosures? What kind of procedure do you guys go through?
So when we started working on the standard, really full on in 2014, we started regular briefings to our audit committee and senior management. And we went through the various different options that we thought, were available or that made sense. And we recommended, with, PwC looking at, who's our auditors, what do we think best meets the spirit of the standard, whether it was on disaggregation or, the other disclosures. And so, getting audit committee engagement early and often, I think, was the really important part, because ultimately they own, the responsibility for ensuring the standard is appropriately implemented. And obviously management's recommendations and getting senior management to understand, was very important as well. So that's essentially the process we followed and did it very regularly and without numbers at first. Just this is the categories we think need to be disclosed. We're working on the amounts, but, does everybody sort of get that or understand it or have any concerns?
Thanks, Mike. I know GE has done a lot of work over the last few years in revamping disclosures in the financial statements, as well as actually a lot of exemplary work in their overall packages outside the financial statements to make them more accessible to investors. So I'll take the opportunity to commend you guys on that. But do you have anything to add, Russell, to what Mike's view is, this whole idea of sort of a disclosure committee and thinking through disclosures? I'm not sure it's that transparent to investors as to how that all works.
Mike explained it well. I mean, that's exactly what you do. You have a financial reporting team and a disclosure committee, and there's a lot of discussions with the audit committee as well on the disclosure. So it's a good process. It requires a lot of thought, and you can't really start early enough in terms of, as Mike pointed out, you really need to be thinking about disclosures as early in the process as possible.
Okay, thanks, Russell, and thanks, Cullen. Do we have anything from your end?
One thought that came to mind is, as Russell has been answering these questions, is unfortunately for Russell, he has to wear many different hats because General Electric is a key player in many different businesses. And, Russell, a lot of your comments today were about aerospace because that's the objective of our webcast here. But any thoughts on how this impacts other businesses? I mean, clearly you're having to do a business by business assessment. Anything that's at top of mind in terms of things that had we been on a healthcare discussion or some other discussion where there's just a different element to implementation for you versus your engine business?
Yeah, I mean, it's we have a lot of different businesses that have different types of business models. So we have a number of businesses that have similar business models to aviation and the aerospace and defense industry, where equipment's being built and manufactured over time, and then we service it. So that's a big part of what we do outside of aerospace and defense. So that's similar. But then we do have, as you mentioned, our healthcare business that's a little bit different. It's more about point in time revenue recognition, where you're delivering equipment. It's not highly customized. It's more of a consumer product that has alternative use, and so it's really about when you transfer control of the goods and services. So it's a little bit different based on the business that you're dealing with. And as I mentioned earlier in the discussion, the decentralized nature of GE's operations makes it a bit of a challenge. But that's why we started almost 18 months ago to get ready for it.
One question that we have from an analyst is about accounting for a financing component, and so that would be an arrangement where let's say a customer is given a piece of equipment today, but they don't have to pay for it for 3 years. And under the new standard, the way you'd think about that is that you've given the customer a piece of equipment and you have financed that piece of equipment over 3 years. And so the question from this analyst is sort of what have you been hearing in the A&D space? Do you think that financing elements are key parts of contracts where you'd expect to see some revenue associated with the equipment and then also some interest income, or do you think that'll be few and far between?
Well, I guess because we've always done most of our financing through our GE Capital business anyway. It's always been accounted for as a separate transaction, so that makes it a little bit easier. We'll continue to account for that as separate transactions, which so the equipment is already being essentially discounted for the financing that's provided if we provide it.
And for others in the space that don't have a financing arm, are you hearing much chatter on this issue, or this has not been a major kind of bubbling issue?
No, and Mike may have a different take on it, but I'm not here. I suspect that most of the peers that we have probably do finance through some type of arm, or they're probably already accounted for as separate transactions. But that's really honestly just a guess.
Yeah, and I'd weigh in, Colin. I think on the defense side, there's not usually any financing element. You have, some holdbacks and other things with the U.S. government that are requirements, but they're not for financing. They're really protective items. Similarly, you may have advances from, customers, but again, protective given, a lot of times you're dealing with a sovereign. So, there's very few times that we would, I think once in my career I've seen it where there was a direct financing. I think it is more prevalent on the commercial side of A&D. So, where you're, also providing finance, whether it's a GE or some of the airplane manufacturers.
Okay, thanks, Mike, and thanks, Russell. I just wanted to take this opportunity to thank you guys both very, very much. We're really, really grateful to have you take time out of your day to help us educate investors. Let me turn it over to Jeff for some closing remarks.
Great, thanks, Mark. With that, we'll conclude today's webcast. Thank you again, Mike and Russell, for participating, and to the listeners for you all for joining us. Today's event's going to be archived on the FASB website in the News and Media Webcast and Webinar section. I'm told that it should be available starting tomorrow, so if you know anyone that you think might be interested that might have missed today's session, please clue them in. This is the first in a series of webcasts. The next is going to be on Tuesday, June 13th, and we'll focus on software and SaaS, or software as a service, and we'll include executives at Microsoft and IBM. So please keep an eye out for it, and let us know if you have any questions on the impact in those sectors from the new standard. The email where you can send questions for that webcast will be and is currently up and operating. It is tsrevrec info@fasb.org, and we'll be announcing further details next week. Lastly, as always, we welcome input on any of our projects, and you can find our contact info on the website. Thank you all for your interest.